In the space of 48 hours, gold traded like a crisis asset and a victory lap at the same time. After printing a record high of $5,726 per ounce in late January, it snapped lower, then clawed back above $5,000 again, closing around $5,079 for April delivery as the new week opened. 22%, a level that sounds ordinary until you remember what gold was screaming at the same moment. Confidence is being repriced. That split matters because these two markets usually agree on the direction of fear. Bonds rally and yields fall when investors want safety. Gold rallies when the world doubts paper promises. When both shout safety at once, it can be a clean risk-off story. But when yields look calm, almost bored, while gold acts like the fire alarm the market is telling, use something more unsettling. The stress may not be in the headlines. It may be in the plumbing. This is the part most people miss. The biggest moves do not start with a breaking news banner. They start with flows, quiet reallocations, a change in what is accepted as collateral, a subtle shift in how institutions hedge. And by the time the public notices the new regime, the price discovery has already happened in the darkest corners of the market. They said this could never happen. They said the era of stable inflation expectations and well-anchored bond markets meant gold would be a sideshow. Yet the metal surged more than 60% through 2025 and kept pressing higher into early 2026, even as official narratives insisted the system was functioning. When a market that trades 24 hours a day moves like that, it is not because of one viral post or one retail stampede. It is because the largest balance sheets on earth are making the same adjustment in different languages for the same reason. What I'm about to lay out is not a prediction, it's a pattern. And once you see it, you can't unsee it, because the numbers line up across bonds, bullion, currencies, and positioning in a way that only happens when macro flows shift. Welcome to Macro Maps, the place where we decode what matters before it becomes consensus. If you like analysis that follows filings, flows, and historical precedent instead of noise, you're in the right place. Consider subscribing the way you'd keep a wise elder close, not for hype, but for perspective when everyone else is emotional. And drop a comment with where you're watching from, because this is a global story and the map looks different depending on where you stand. Now, let's reconstruct the scene. Late January delivered a shock. Gold surged to 5,626, silver hit 121, and then both buckled hard. A move that wiped trillions off the notional value of precious metals exposure in a matter of sessions. The trigger wasn't a meteor. It was a change in expectations and a chain reaction in leverage. A prominent policy nomination shifted assumptions about the future path of rates. Volatility spiked. Margin requirements tightened in key venues. Forced liquidations cascaded. And the price action looked like a verdict. But then the market did something that weak narratives don't survive. It stabilized. It regrouped. And it climbed back over the number that matters psychologically, 5,000. On February 9th, gold futures settled around 5,079, 874 near multi-year lows. Twos. That combination is the central mystery. If the dollar is weakening and gold is roaring, you might expect yields to drop sharply as the market prices easier policy, or to rise sharply as the market prices inflation. Instead, yields looked contained. That's exactly what macro regime shifts look like. The old relationships don't vanish overnight. They distort, they stretch, they become unstable. And the distortions show up first where leverage lives, because leverage is the fastest messenger of stress. To see why this matters, you have to go back. In 2008, the world learned that safe could mean two different things. Treasury bills became the refuge because they were the closest thing to cash. But gold also began a multi-year run because the response to the crisis required expanding central bank balance sheets and compressing yields. The immediate crisis was deflationary, but the policy response was reflationary, and gold sniffed that out early. In 2011, another version of the same playbook appeared. Sovereign debt stress in Europe pushed investors into the most liquid collateral they could find. At the same time, gold surged as confidence in fiscal trajectories and political cohesion frayed. Bonds and bullion were both signaling safety, but for different reasons. One for liquidity, the other for solvency. Then 2020, a global shock hit, and in the early weeks, there was a scramble for dollars so violent that even gold sold off briefly as investors raised cash. But once policymakers opened the liquidity floodgates, gold resumed its climb, and yields were pinned by aggressive interventions. Again, the pattern, a short, sharp liquidity squeeze, followed by a longer repricing of money itself. Now look at 2026. We have a market that can produce record highs above 5,600, endure a historic liquidation, and still reclaim 5,000 with conviction. That is not a normal bull market in a shiny commodity. That is a message about what the marginal buyer values, a store of value that is no one else's liability. Here's where it gets interesting. The official sector has been buying into this message for years, and the numbers are not subtle. 3 tons of gold. That is not a typo. It's official net buying, with roughly 230 tons added in the fourth quarter alone, a quarter-on-quarter increase of about 6%. Poland led the list with around 102 tons added. When a central bank buys gold, it is not chasing a quarterly return. It is adjusting the architecture of reserves, and the official sector is only one piece. The private sector has been voting too, often through the most boring mechanism imaginable, rebalancing. When investment demand for gold surges, when ETFs see strong flows, when bars and coins move, it is the public expression of a slow institutional process. The question is not whether gold is popular. The question is why the demand persists, even when the price is already high. One easy answer would be speculators, but positioning data complicates that story. 6,000 in early February. In other words, the hot money was reducing exposure, yet the market still held the 5,000 line. That tells you the marginal bid is not just leveraged momentum. There's a steadier hand involved. Now, zoom out to bonds. 22% can be interpreted in two opposing ways. In the old world, it might mean markets believe inflation is contained and growth is steady. In the new world, it might mean the bond market is being anchored by structural demand for collateral and duration, even as other parts of the system are quietly seeking alternatives to dollar claims. This is the dislocation. Gold says credibility is being tested. Yields say the system can still finance itself at a tolerable price. The dollar index says global demand for dollars is thinning at the margin. And that combination forces a single question. Which market is lying and which market is simply lagging? Markets don't lie on purpose. They express constraints. The bond market can be constrained by regulation, by liability matching, by bank balance sheets, by pension mandates, by the need for high-quality liquid assets. Gold is constrained differently. It is a settlement asset with no yield, which means the only reason to hold it is because something else looks less reliable. So when bullion heats up while bond yields cool, you are watching two different safety bids collide. One is a bid for liquidity and collateral. The other is a bid for trust. To make this concrete, imagine a city with two kinds of shelters. One is the biggest building with the most exits and the widest doors. Everyone runs there because it can absorb a crowd. That's treasuries. The other is a bunker built into bedrock, hard to access, not designed for comfort, but designed to survive any storm. That's gold. In a normal storm, people choose the big building. In an existential storm, they choose the bunker. When people run to both at once, the storm is not normal. The mechanism that creates this split often begins with something that looks unrelated: leverage. When volatility rises, margin requirements rise. When margin rises, some participants must sell what they can, not what they want. This is how a gold market that is fundamentally strong can still experience a violent drawdown. The sell-off is not a verdict on the thesis. It is a mechanical response to a higher cost of holding risk. During the late January liquidation, that mechanism was visible. Precious metals fell fast enough to trigger margin calls. Traders sold to meet them. Liquidity gaps widened. Then, once the forced selling exhausted itself, the underlying bid reasserted. The speed of the rebound is the clue. Weak markets do not recover key psychological levels with that kind of urgency. But the more important mechanism is not margin. It is collateral. In modern finance, collateral is the oxygen. They operate on what can be pledged, rehypothecated, posted, and netted. U.S. Treasuries are the premier collateral in that system. A large share of global funding markets is built around them. When demand for collateral is high, Treasuries can be supported even if the macro narrative is messy. At the same time, if participants begin to worry about the long-term integrity of the system that issues that collateral, they seek a hedge that sits outside it. Gold is the oldest version of that hedge. That is why it can surge, even when bond yields do not collapse. Treasuries are needed for the machine to run. Gold is needed when people worry about the machine itself. This is why the official sector matters so much. Central banks are not just investors. They are the architects of the system. When they buy gold in size, hundreds of tons in a year, they are making a statement about diversification, away from over-reliance on any single issuer's promises. And it's not only about gold, it's also about what happens in currencies. 874 is not merely a chart point. It's a signal that the global appetite for holding dollars as the default buffer is not infinite. That can happen for many reasons: relative growth, relative rates, fiscal expectations, geopolitics. But when it happens alongside persistent central bank gold buying, it starts to look like a structural flow, not a cyclical trade. Now, the counterargument is obvious. If trust is eroding, why aren't bond yields exploding? Why isn't the bond market screaming? Because bond yields are not only a referendum on trust, they are also a reflection of constraints and sometimes a reflection of intervention. Yields can remain orderly even when credit is mispriced, if the market's largest participants are required to hold the asset. Banks must hold liquid assets. Pension funds must match long liabilities. Insurance companies must manage duration. Foreign reserve managers must park surplus in liquid instruments, and when volatility threatens the system, the incentive to own what can be financed most easily can outweigh the desire to avoid the issuer, so the bond market can appear calm at the same time the currency and gold markets are warning you. That calm is not reassurance. It is a sign that the system is still able to roll its funding, still able to warehouse risk, still able to quote prices. The question is, what happens if that ability is tested? Historically, when you see a bullion bid that refuses to go away, you are watching a credibility test build. The test has a few predictable stages. Stage 1 is disbelief. Gold rises, and commentators say it's just a trade, just geopolitics, just a weak dollar. Stage 2 is volatility. A sharp liquidation occurs. People declare the move over. Stage 3 is persistence. Gold regains levels, holds them, and keeps attracting official and private demand, even when positioning data says speculators are not driving it. Stage 4 is spillover. The stress leaks into other markets. Currency volatility, funding stress, or abrupt policy shifts. We've seen this movie. In 1971, the dollar's link to gold was severed. The immediate result was confusion. The longer result was a decade of inflation and a repricing of real assets. In 1980, gold peaked as the policy response finally slammed the brakes on inflation. In 2008, the system cracked. The immediate response was deflation fear and a dash for dollars. The longer response was unprecedented monetary expansion and a multi-year rise in gold. In 2020, a liquidity shock forced selling across assets. Then policy support anchored yields and pushed investors towards stores of value again. The specifics differ, but the playbook rhymes: a shock, a policy response, a repricing of confidence. Now, the players. You have to think in layers. Layer 1 is the official sector. Central banks adjusting reserves, not for returns, but for resilience. 3 tons bought in 2025 is not a weekly story. It is a structural story. Poland's 102 tons is not a trade. It is a strategic allocation. Layer 2 is the market infrastructure. Exchanges and clearinghouses managing volatility through margin. Margin hikes are not a moral judgment. They are a mechanical response to price swings. But they have consequences. They force deleveraging. They change who can participate. They turn a paper move into a physical flow, as some participants prefer fully paid assets to margined exposure. Layer 3 is the institutional investor ecosystem. Funds, banks, and asset managers balancing portfolios. When stocks are volatile, when rates are uncertain, when currencies weaken, and when gold offers a hedge to systemic risk, allocation models shift. Not dramatically at first, quietly, but the sum of quiet shifts becomes a tidal force. Layer 4 is the global saver, households and corporates around the world responding to the same signal in different ways. Some buy gold, some buy dollars, some buy property, some reduce leverage. These micro decisions become macro flows. The coordination, if you can call it that, is not a conspiracy. It is timing. When the same constraints hit different players at once, higher volatility, higher margin, political uncertainty, fiscal questions, their responses align naturally. That alignment is what markets call correlation. And correlation is what makes dislocations dangerous because everyone reaches for the same exits. So what is the dislocation here precisely? It's the gap between paper calm and physical urgency. In the bond market, you see orderly yields. In the gold market, you see a persistent bid that survives liquidation. In the currency market, you see a weakening dollar index. In positioning, you see speculators stepping back even as price holds. Those are not consistent signals. Another way to describe it is east versus west, without turning it into mythology. When official reserves shift toward gold, it often reflects a desire for neutral settlement assets. When investment demand surges, it often reflects a desire for hedges against policy uncertainty. When the dollar index weakens, it often reflects a shifting marginal preference in global capital flows. Put together, it suggests the world is experimenting with diversification. At the same time, it still relies on the dollar system for day-to-day liquidity. That tension cannot remain static forever. Either the gold bid cools and the old regime reasserts, or the bond market eventually reacts, or policy shifts to reconcile the contradiction. This is where the evidence matters. We have an exact record high in gold near 5,626 in late January, a retracement, and a recovery above 5,000 with a settlement around 5,079, 874, 22%. 3 tons in 2025, with 230 tons in Q4, and Poland adding 102 tons. 6K, indicating the rally is not purely leveraged froth. Each of these numbers points to the same conclusion. The marginal buyer of gold is not easily shaken, and the bond market is not fully reflecting the same stress signals yet. So what does this mean forward? The conservative scenario is that the bond market's calm is justified. Growth cools just enough, inflation moderates just enough, and policy remains credible enough that gold's surge is treated as an overreaction. In that world, gold can consolidate, volatility declines, and yields drift within a range. The moderate scenario is that the contradiction forces policy choices. If the dollar continues to weaken and gold remains elevated, policymakers face pressure, defend currency credibility with tighter policy, or support growth in funding markets with easier conditions. Historically, that tension tends to produce volatility in rates and a repricing of term premiums. The aggressive scenario is that the plumbing becomes the headline. A funding squeeze, a collateral shortage, or a sudden change in risk appetite forces leverage participants to unwind. That is when you see abrupt moves in yields, not because of inflation data, but because of liquidity. In that world, gold's role as a non-liability asset becomes more prominent. Notice what's missing. There is no guaranteed outcome. The data suggests stress, not destiny. But the pattern tells you what to watch. Watch whether gold holds key levels even as positioning remains cautious. Watch whether the dollar index continues to weaken or stabilizes. Watch whether the 10-year yield stays orderly or begins to gap. Watch margin and financing conditions, because the first true cracks often appear there. One more layer makes the picture sharper: real yields and the psychology of duration. When investors believe a central bank has control, long bonds become a confidence trade. When investors suspect that control is constrained by fiscal math or market structure, long bonds become a collateral trade. That shift is subtle, but it changes everything. A confidence trade can unwind slowly. A collateral trade can unwind suddenly because collateral is either acceptable or it isn't. Think about the repo market like the heartbeat of the system. Treasuries are the most widely accepted good collateral, so they circulate through dealer books the way water circulates through pipes. If there is fear that liquidity will tighten, demand for that collateral can rise, keeping yields pinned even while other assets warn. Now, that's how you can get the illusion of calm in yields. It's not calm, it's a squeeze for the same oxygen. Gold sits outside that machinery, which is why it becomes the lie detector. It doesn't care about overnight funding. It cares about the long arc of purchasing power and settlement trust. When the metal stays bid while speculative positioning cools, it suggests the buyers are thinking in years, not days. If you want a simple checklist, it looks like this. First, does volatility force selling, and does gold rebound quickly anyway? Second, do official buyers keep accumulating quietly in the background? Third, does the currency signal drift in the same direction as gold, even when rates look steady? When those three line up, history says the market is preparing for a change in the rules, not just a change in the price. And now the divide. The difference between those who navigate regime shifts and those who get whipped by them is not intelligence. It is attention to flows. Most people look at price and assume price is the story. Institutions look at what price implies about funding, collateral, and confidence. They move before the story is told, because they are the story's authors in real time. Retail reacts last, not because retail is foolish, but because retail does not live inside the funding markets. Retail sees headlines. Institutions see settlement. Retail sees charts. Institutions see balance sheets. And when a macro flow shifts, the wealth gap becomes an information gap. So the question is not whether bonds and bullion can diverge. They already are. The question is what the divergence is telling you about the next test: credibility, liquidity, or both. This is Macro Maps, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the real edge is not a secret indicator. It is the willingness to follow the numbers when the narrative gets comfortable.